Hey, I've seen a lot of real estate investors treat their self-directed IRA like a personal piggy bank. And I'll tell you what, the IRS, they see these things as minefields. Listen, one simple mistake, something as small as paying a contractor out of the wrong pocket or fixing a sink yourself, doesn't just result in a fine. It could trigger a total disqualification, meaning your IRA is a complete taxable distribution on day one. Well, today I'm going to be breaking down the disqualification traps and the silent tax known as UDFI that could eat up 37% of your profits before you even see them. So if you own property in a self-directed IRA, you need to check your structure against these two rules immediately. All right? Let's get started. Okay, I want to talk about the first issue you need to be aware of. This is the number one problem, I think, for self-directed IRA investors who engage in a prohibited transaction. And this first one is what I'm going to refer to as the sweat equity trap. All right, so what is the sweat equity trap? All right, this happens to be, like I said, the number one violations. You see, most real estate investors, a lot of them are used to being hands-on. But the IRS says, hey, a disqualified person cannot provide services to their IRA. And so, first off, what is a disqualified person? Because this applies to all the issues I'm going to be raising for you. So a disqualified person is you, your spouse, okay? So actually, let's just draw it out. So here's you, okay? You're a disqualified person to your IRA. The person you're married to is a disqualified person. And then after that, it goes like this. Anybody below you, your children, they're all disqualified people. And you go up above, your parents are all disqualified people. So if any one of these individuals right here do anything on your property that's held inside of a self-directed IRA. I mean, we're talking about paint the walls, fix the plumbing, go out and mow the grass even, right? If they do anything like that, then it's considered to be a prohibited transaction because they're adding value to the IRA. Normally, you'd have to pay for that to be done. And it gets even more technical because a lot of times what I've seen is that people who buy or use self-directed IRAs when they're investing in real estate, they're rehabbing properties. So they find a great deal and then they're going to rehab it. Now, this is where the fine line comes in because managing the rehab, say I'm this individual here who owns the IRA is managing the rehab, well, he could step over the line because you can't act as a project manager or general contractor. All right, you can provide basic investment oversight, but you have to hire someone to do this. So these are all the things that can run into this sweat equity trap. Whenever you're doing something that the IRS would look at it and say, hey, by you performing that service for your IRA, then it is adding value to the IRA. And therefore, that is a prohibited transaction. Okay, so the second issue that we have with self-directed IRAs where they get punched is what is referred to as self-dealing and disqualified persons. So let me just write that up there, self-dealing. Okay, I'm not gonna write the disqualified persons, but that because it applies to everything here. So here's what you need to be aware of. Section 4975, okay, of the Internal Revenue Code. This lays everything out, okay? If you just read that section, you'll know exactly what you can and cannot do between an IRA and a third party that is considered to be a disqualified person. Now, every IRA LLC that you set up, that is an LLC that is going to be owned, let's say that here's my self-directed IRA. If you've watched my other two videos in this series, you'll see that I've drawn this out multiple times in those. In fact, I'm going to put a link right up here to those two videos that you can go and watch. Now, in that type of scenario right there, whenever you're creating this limited liability company, it's a very special type of operating agreement that must incorporate these 4975 prohibitions in there to ensure that if you get audited, that they do not disqualify your IRA. So if you've set up an LLC to be owned by your IRA, then make sure that you have these provisions in there. So what does Section 4975 do? What does it state? Well, here's what it doesn't want to see happen. All right. So if I have an IRA here, I cannot do something like this. Let's say I have real estate. I can't sell property to my IRA. That is considered to be self-dealing with a disqualified person. Remember those disqualified people I talked about again? Parents, children, and spouse, or even an entity that you own. I didn't add that one in. So I couldn't do this, nor could I sell a house out of my IRA to myself. That is a impermissible transaction. Now, I've run into individuals before who have done things such as they have bought a house inside of their IRA. Let's say they bought one down in Tucson, Arizona. So their daughter is attending University of Arizona. Now, since they have the house inside of the self-directed IRA, they say, all right, honey, you can stay in this house. Or they figure, no, maybe we can't let her stay there. We're going to rent it to her for fair market rent. So that's, it's an arm's length transaction. Sorry, that doesn't work as well. You cannot do that. Or if you buy a vacation home, right, inside of the IRA. So essentially you can't make loans out of the IRA. You can't pay family members out of the IRA to do things. So these are all disqualified parties. And that is a huge slip up when it comes to using this. You have to be compliant with Section 4975. All right, the other problem is the indirect benefits. All right, so let me just put that up there. Indirect benefits. So what is this one? All right, so the classic example is what I saw many years ago. So an individual had a self-directed IRA set up. So she had this self-directed IRA right here, and she had quite a bit of real estate held inside of various LLCs, like I showed you in my previous video about how to structure your IRA the proper way for asset protection to own real estate. So she had these LLCs set up as follows. Now, she was flipping property. So I'm not going to get into the tax issues on that right now. We're going to talk about that in a moment when we get into the UDFI or UBIT stuff. But she was flipping real estate. So she wasn't engaging in any of the self-dealing or sweat equity traps. Now, she had other people doing it. But here's where she ran into the indirect benefit problem. When she would sell a property, she happened to be a realtor. So she would list the property for sale and she would take a commission on the sale. So that commission created the indirect benefit trap, which resulted in this IRA being being disqualified. So you have to be extremely careful with the indirect benefits. You cannot get any benefit from your IRA. Another example that I've seen many times with real estate investors, and I just don't know how this happens, is that they want to buy real estate inside of their IRA and they're going to use financing. Now, in the next section, I'm going to be talking about debt and what that means as far as from a tax standpoint. So you can buy property and use leverage, but you have to be very careful how you structure the deal. Now, the individuals that I'm referring to were not careful, and the people did not warn them what they were doing was creating a prohibited transaction. You see, when they went to borrow money to buy this property inside of their IRA, they gave a personal guarantee. That is referred to as a recourse loan, is what they got. So if the IRA defaulted and didn't pay the lender back, then let's assume this is the lender over here, then the lender can go after the asset, the IRA, and the IRA owner. And because the IRA owner pledged their security or their assets as collateral for the loan, because if you come after me, you can come after my assets, that is considered to be a prohibited transaction. So the only way you get around this, if you want to buy real estate in an IRA and use debt, is you have to use what is referred to as a non-recourse loan. That is where the lender can only look to the IRA for recovery against the asset. Now, there are lenders out there that issue these types of loans. Okay, you're going to typically have to have more down and you're going to pay a little higher interest rate, but they are available. All right, so that's number 3. Now, number 4, the fourth main issue that we find is co-mingling of funds. So 4 is co-mingling of funds. All right, now, here's what can happen. Let's assume that I have an IRA, and this is what actually occurred with another individual that I met. So she had her self-directed IRA, and it owned a multifamily property inside of that IRA. And what she started doing with this is that when she had CapEx, because the property was not generating enough cash flow, but she'd have a turn on the property and she needed more money to rehab that unit so she could turn it to bring in another tenant. So she's out here on the side and she's now putting money into her IRA to pay for the rehab. In fact, she showed me all these IOUs from her IRA back to herself. Now, that right there is a commingling issue that is going to result in a disqualified transaction. On top of that, I mean, this gal just poured all the wrong things all over herself. If you want to blow your IRA up, she was the poster child. In addition to that, she served as the on-site property manager and lived in one of the units. All right, well, look at that one. That's number two right there, self-dealing. Number one, we just checked the boxes on everything in 4975. She was doing that. So that's an idea of commingling that could be a problem for you. When your IRA runs low on cash, you just can't move money in. You can make a contribution, or maybe you have a 401k that you can, or another IRA, you can roll into that IRA to cover the expenses, or you go to a third party and get a non-recourse loan. Now, the last thing here on the commingling that I want to bring your attention to is something that I've seen before as well, and it really concerns me. So there was a gentleman I met at an event, in one of my in-person events that I teach, and he explained to me that he has a self-directed IRA set up and he has no asset protection. And he wanted us to help him design out a plan, like I discussed in my prior video here, to protect his assets. And so as I started digging into what he was doing with this, and I explained to him, here's what we're going to do. We're going to set these companies up, and then you got to have your tenants pay the company itself, or if you're using a property management company, it'll collect the rents. I was just walking him through this, and he said, oh, no, that's not going to work. And I said, what do you mean it's not going to work? He said, my tenants pay me in cash. And I said, they do? He goes, oh, yeah. He goes, I collect all the cash from my tenants because they can't send cash to the IRA custodian. Then I put it into my checking account. Then I send my custodian a check. And I said, that's a prohibited transaction. He goes, no, it's not. My custodian cashes the check and puts it in the IRA. I'm just there to collect the funds. I'm not doing anything. I said, yeah, you're touching the money. You see, the rents need to be deposited directly into the IRA. They can't go through you, all right? Because if they do, then you've entered into a disqualifying transaction. So this is major stuff here if you're going to involve yourself in this. Now, what is the implication to you? All right, I've been laying out 4 major areas that can create a problem for your IRA. But if you're wondering, should you be listening to this? Well, let me just show you how this works from a tax standpoint if your IRA engages in one of these prohibited transactions and you get caught. So let's assume that our investor, John, okay, say he has his self-directed IRA and it has $475,000 in assets. And that could be the property plus any cash inside of the self-directed IRA. And so he has this rental property there, right? And he's got tenants in the property. And he decided one day that he wants to save $1,500 by painting the unit himself, right? And replacing some light fixtures. So he goes out there and he does this work inside of his IRA, right? So he saves $1,500 by not hiring a third-party contractor. He does all this work. Now, by John doing this, he just violated that sweat equity rule that I talked about. Under 4975, he's a disqualified person. So this is a prohibited transaction. Now, what are the ramifications to John by doing this? Okay, so if the IRS were to catch this, they're going to disqualify his entire IRA. And if they do that, then whatever's inside of the IRA at that point in time is going to be what we call, number one, a deemed distribution. So essentially, John is going to have a distribution of $475,000. Now, what does that mean to him from a tax standpoint? Well, if John's in a 32% tax bracket, then the deemed distribution of this will result in approximately $152,000 in taxes. All right, so he's going to have about $152,000 in taxes on that $475,000. Now, assume he lives in a state that has a state income tax, I don't know, 5%. So you have federal here. Let's say there's state as well. So at 5% on that, that's going to be about $23,750 in tax. Now, that's not the only problem John's facing, right? Because John is 48 years old. Now, because he's under 59 and a half, he's going to get hit with an extra 10% early distribution penalty on top of that. Now, that distribution penalty is on this amount, not the after-tax amount. So we'll call this one early distribution penalty 10%. Okay, that's going to be $47,500 there. All right, so John now has been hit with all of these taxes. Now, in addition to that, there's also going to be another penalty. If John did not paint the house and instead he brought his son out, who's a disqualified party, then his son would be subject to a 15% excise tax penalty as a disqualified person. And that means his son would have to pay this tax on top of that. So that's another problem as well. If you're going to screw this up, screw it up yourself and don't put this liability on a family member. So ultimately what happens here, if you add all this stuff up right here, by John painting one room and saving $1,500, he created a $223,000 tax liability for himself by doing this. You essentially gutted 50% of your IRA. Imagine, right? You're John, you have $475,000 in your retirement account and you think you're being savvy by heading to Home Depot and buying $50 worth of paint and spending a Saturday afternoon freshening up the property. Listen, to the IRS, you just didn't save money, right? They're going to dissolve your entire IRA. So this is a real problem for individuals who invest through a self-directed IRA. They need to be aware of this and what can go wrong. Okay, so the other thing about this that I want to say is that the retroactivity of this goes back to the first day of the year. So whatever your account, whatever gains and everything you've had on that account, all goes back to the first day of the year. All that now is taxable to you when it gets caught. So this is a real problem that you need to be aware of. Now, one thing that is also important, unlike a 401k, which I'm going to talk about in my next video. So be sure to watch that, as there's a solution to all this, okay, that takes you out of this draconian rule here about disqualified party and what it means to you from a tax standpoint. Okay, so unlike a 401k, the IRA does not have a self-correction rule associated with it. So you're going to learn with using a solo 401k, you can fix these problems and not have to go through what John went through in this transaction. So be sure to catch that next video. If you haven't viewed it already and it's already been dropped, be sure to watch it. All right, now, the next thing I want to cover for you, taxation. Okay, so these taxes here were the result of someone doing something, making a mistake with their IRA. But here's where we also run afoul with using self-directed IRAs. You need to be aware of this. And it's called the 60-40 UDFI rule is how I refer to this, all right? And what that means is unrelated debt-financed income. So let me explain to you what that looks like. Let's say your self-directed IRA buys a rental property. So here's my IRA, and it purchases a rental property for $500,000. So here's the purchase price is $500K. Now, I use $200,000 of my IRA cash for this, okay? And then I take out a non-recourse loan. Remember I talked about that earlier. The loans have to be non-recourse for $300,000. So my cash goes into the deal and then I borrow $300K. Okay, so this is a loan to end up purchasing this $500,000 home. So this is the 60-40 thing here that I'm getting at. 60% of this purchase price of $500,000 was the result of what we call debt, and 40% here came from my contribution of cash. Now, generally speaking, the reason I call this the 60-40 rule is that a lot of times when you're investing and you're using debt inside of a self-directed IRA and you're obtaining a non-recourse loan, I told you have to put more down. 40% is a good safe number you can count on. Sometimes I've seen loans at 30%, rarely more than 25%, minimum 25% down, but those are far and few between. 40% seems to be the norm out there if you're going to go this route. Some even more, 50%. But nevertheless, let me show you what happens here. All right, so let's assume that this property you bought for $500,000 with a $300,000 loan generates $30,000 in income for you. So let me clean this up a bit here. Okay, so we generate $30,000 in income in 2026 on this property. Okay, so this is our income from 2026. Remember, we bought it for $500,000 and we have $300,000 debt, okay, on the property. Now, okay, this income that we brought in, okay, since we bought the property with other people's money, right, the bank's money, then the IRS says that 60% of that profit is unrelated to your retirement account. Meaning your retirement account didn't make the contribution to buy this property. That's not where the money came from. It came from another party. So they take the debt ratio of 60% and they multiply it by your income. So in this case, 60% of $30,000 will equal $18,000 in debt-related income. Okay, did you see what I did? All I did is I took this number here, which represents 60% of that purchase price. So I take the 60% and I multiplied it by the income for the year, and that gives me this number right here, $18,000. Now, here's where this gets painful. You see, IRAs are taxed at trust rates. So your self-directed IRA is going to have to pay taxes on that $18K. And trust rates are very compressed, meaning that as soon as you get up to just over, I think it's $15,000, the rates jump up to basically 37% and greater. So in this case right here, what it would go through is that on the first $3,300, it's going to be 10%, and the next 24% is it'll result in $2,000. It just keeps averaging up, and so essentially what ends up occurring here is that on the $18,000, your IRA will have to pay the IRS $4,591 in taxes. Okay. Now, you thought that your IRA was either tax deferred or tax exempt, but that's not the case. All right. Even though the money's in your IRA, you're still handing over, in this case, about 15% of your profits to the IRS. And it gets worse. When you sell the property, 60% of your capital gains will get hit with this tax. That is why the next video that I have coming out with the solo 401k, I refer to that as the self-directed IRA killer, because in a solo 401k, when you watch that video, you're going to see that this does not apply. Now, if you're worried about UDFI and you're already in this position, okay, there is something that you can also be aware of, that I want you to be aware of here when it comes to this. And that is that when you're calculating out the income, understand that I was talking about net income here. Okay, so what can happen here is that if you get to use depreciation. So if you can depreciate your property, then you might be able to drive this income down after depreciation. Maybe you're only looking at about $8,000 in income. Now the 60-40 rule in this example, 60% $8,000, it's not that much. And so the income on that's going to be relatively low. In fact, if your UDFI is less than $1,000, you don't have to file Form 990T. Okay, so the 990T form, this is what is required for IRAs that have UDFI. You have to be filing this. And if you're missing it, and you're having the income like I just described here, then this could be a problem if you get caught. If you're audited and they catch this, you're going to be paying taxes. All right, so be aware of it, and make sure that you're getting compliant. Or the other option you have is, as I stated, when you learn about the other strategy, roll out of the IRA into a solo 401k if that's possible, and then you no longer have this concern. Listen, if you're watching this video and you're realizing you might have already stepped on one of the landmines I'm talking about, don't panic just yet. I get this a lot. People come up to me when they hear this presentation at one of my live events, in-person events, and they start just panicking, going, what do I do now? The IRS are gonna come after me and blow up my IRA. The likelihood of that happening is probably pretty small, but with the new AI that the IRS is putting into effect, the likelihood of being audited might have gone up a little bit, and so you should be cautious here. Now, there are strategies like I talked about to minimize this. In fact, I put together a 2026 self-directed IRA safe harbor checklist that shows you exactly how to structure your oversight so the IRS can stay away from your account. Listen, YouTube doesn't like it when I put external links in the description, so when I'm doing something better, just comment the word safe below, and I'll personally reply to your comment with a private link to download the checklist. This also lets me know that you're taking your protection seriously. Hey guys, if you liked the video, be sure to hit the like button. If you're not yet a subscriber, subscribe, and as soon as I drop my next video on how to solve for this problem, you're gonna get notified. Take care.